Many investors look to high-yield dividend stocks with the hope of generating more income from their investment portfolios. The problem with doing this is that often these high-yield stocks have unsustainable payout ratios. Their dividends exceed their earnings or they exceed their cash flows, and this inevitably leads to a dividend cut. In today's video, I'm going to introduce to you 5 dividend stocks that have high yields and sustainable payout ratios that you could potentially buy today. The first high-yield dividend stock that we'll talk about is AT&T. AT&T is the largest domestic telecommunications company in the United States by market capitalization. Its only competitor of similar size is fellow telecom giant Verizon Communications. AT&T is perhaps the single safest stock with a yield above 5%. It currently yields 6.3% and, using 2018 earnings guidance, is on pace for a payout ratio of 58%. AT&T is also trading with an absurdly cheap valuation right now. We believe the company has a reasonably good chance of printing earnings per share of about $3.45 next year. What this means is that AT&T is trading at a price to earnings ratio of just 9.3. For context, AT&T has traded at an average price to earnings ratio of 13.4 over the last 10 years. We believe that valuation expansion will be a meaningful contributor to this stock's total returns moving forward. The next high-yield dividend stock that we'll talk about is Owens & Minor. Owens & Minor is a healthcare logistics, distribution, and transportation company. It's likely that you haven't heard of this company because it's a small cap stock. Owens & Minor trades with a market capitalization of just $1.1 billion. Still, we believe there's a lot to like about Owens & Minor right now. The company is trading with a dividend yield of about 6%, and that yield is well covered by underlying fundamentals. For context, the company's on pace for a payout ratio of just 52% for 2018. Like AT&T, Owens & Minor is also very undervalued. The company is on pace to deliver earnings of about $2 per share next year, which means that it's trading with a price to earnings ratio of just 8.6. We believe that Owens & Minor has a fair value of somewhere between 14 times earnings and 15 times earnings. Either way, the company seems well positioned to deliver excellent total returns based on its high dividend yield and potential valuation expansion. The next high yield stock that we'll talk about in this video is Altria. Altria is the largest cigarette company in the United States. It sells the Marlboro brand of cigarettes as well as several non-smokable brands and the Saint Michel brand of wine. Altria also has a 10% stake in the alcoholic beverage manufacturer Anheuser-Busch. Altria is well known for being a high-yield dividend stock. The company currently trades with a yield of 4.9%. Altria's management team has a target payout ratio of 80%, and the company is on pace for a payout ratio of just 73% in 2018. This means that we believe that there's a good chance that dividend growth in the near term will be accelerated. Altria is also trading at a cheap valuation, just like the other stocks we've talked about in this video. The company is on pace to deliver earnings per share of $3.96 next year, which implies a price to earnings ratio of 14.3. Altria's 10-year average price to earnings ratio is 16. What this means is that we have a rare opportunity to buy a high-quality business at an excellent price, which should deliver excellent returns for investors over full economic cycles. Moving on, the next high-yield stock that we'll talk about is Omega Healthcare Investors. Omega Healthcare Investors is a real estate investment trust, or a REIT, that generates 85% of its revenue from skilled nursing facilities and the other 15% of its revenue from senior housing developments. What immediately stands out about Omega Healthcare Investors is its very high yield. The trust currently trades with a dividend yield of 8.4%. Importantly, because Omega Healthcare Investors is a REIT, its dividend safety must be analyzed in a way that's different from its common stock counterparts. More specifically, we have to use funds from operations when calculating its dividend safety, not earnings per share. Using Omega Healthcare Investors company guidance, we believe it's likely the company will deliver funds from operations of $3.01 in fiscal 2018. Using this guidance, Omega Healthcare Investors is on pace for a dividend payout ratio of just 88%, which means that its 8.4% yield is safe for the time being. Omega Healthcare Investors is also trading at a very attractive valuation. Its price to funds from operations ratio, or price to FFO, is 10.4 right now, while its 10-year average price to FFO ratio is 12.4. Like the other stocks on this list, the investors in Omega Healthcare Investors should generate strong total returns thanks to the potential for valuation expansion moving forward. The next high-yield dividend stock that we'll talk about is Enterprise Products Partners. Enterprise Products Partners is an oil and gas master limited partnership. Its asset base includes more than 50,000 miles of pipelines and 250 million barrels of oil storage capacity. Enterprise Products Partners currently trades with a yield of 6.1%. Like Omega Healthcare Investors in the last section, its dividend safety must be analyzed in a way that's different from normal common stocks, because it's structured as a master limited partnership. More specifically, we have to use cash flow as the denominator in the dividend payout ratio, not earnings per share. After making this adjustment, the math works out so that Enterprise Products Partners is on pace for a dividend payout ratio of just 65% in 2018. Enterprise Products Partners also appears slightly undervalued. It's trading at a price to cash flow ratio of 10.6, while its 10-year average price to cash flow ratio is 11.6. While the MLP may not be as undervalued as some of the other securities discussed in this video, modest valuation expansion should still boost shareholder returns moving forward. Thanks for watching this video. I invite you to subscribe to our channel and like this video, which will help more investors find Sure Dividend's educational videos. If you take anything away from this video, let it be this. The peril of investing in high-yield dividend stocks is that they have an elevated probability for dividend cuts. However, careful analysis combined with a broad investment universe can help you identify opportunities that have both high yields and sustainable payout ratios. The 5 companies discussed in this video are examples of this.